We've had a chance to meet with many analysts and economists since our last First Friday meeting, and the diversity of views and the outlooks from each independent thinker are, and they analyze things in their own expert lens. And it's always interesting because the benefit of talking to so many different people over time is that it allows us to believe, to have what we believe to be a pretty well-informed, data-centric view of where we've been and what lies ahead. So our conclusion, as most of you know, because we talked to most of you over time, is that we're entering a pretty difficult period for investors. And the events over the next 6 to 12 months and the market's reactions to each event, it's, the combination of those are likely to create uncertainty for most investors. So in short, the goal for each First Friday meeting going forward is going to be to help every member of our family office develop reasonable expectations for what lies ahead. And I think if we have reasonable expectations, it will allow us to avoid making emotional, spontaneous actions or taking actions that we might regret. And obviously, we want to ensure that each family has the ability to make well-informed, intelligent decisions about their wealth based on their personal goals and future. And so, as I said last time, we're going to continue to have these short meetings each month on the first Friday to help everyone understand the range of consequences created by each of the events that take place in the prior month. And as I said earlier, we hope it's going to allow you to develop reasonable expectations for what lies ahead. So if the meetings are helpful, during what I believe will be, I believe it's going to be a challenging time ahead, but it could become very challenging because of the debt that's out there. And we went over that the last several meetings. But if we're wrong, which we could be wrong, and the future is rosy, we won't need to have these meetings going forward. So I'd like to make also just a real quick personal request from each of you. After this meeting, please take a minute and just jot down or send us a short assessment of what you thought about the meeting. And the bullet points that you could include would be what you think could be more helpful and what you think could be left out. And as I always tell you, diplomacy isn't needed. What we're trying to do is to hone these short meetings into concentrated, valuable information for all of you. Okay. As Marissa said, in this first Friday meeting, we're going to discuss the challenges that are most likely to evolve over the next 12 months. And, the strategies we think will serve intelligent investors well. Second, we're gonna talk about the most important activity each intelligent investor should engage in over the next 12 months. And I want to also make the note about why we think this activity can prove to be incredibly valuable for you. And thirdly, we want to talk about always what's next, and then what we think what the market is missing. That's, as I'd said to you earlier, that's always my favorite part of the show. Okay, so at the end, we're gonna try to answer as many questions as we can if you have them. And as Marissa said, if you have a question, send it to us in a chat. She can aggregate those questions and ask them at the end. And if you'd rather ask them verbally, just raise your hand and we'll get through those. So first, what are the challenges ahead over the next 12 to 18 months? And what strategy or strategies do we believe will be the most intelligent to employ to avoid the pain that I think the Federal Reserve is going to put our United States economy through? So, as you all know, the challenge today is inflation. The solution, according to the Fed, is higher interest rates. Higher interest rates make future earnings less valuable, and higher interest rates decrease future earnings because of the debt load on corporate America. If future earnings are lower, and if future earnings are less valuable based on higher interest rates, stock price appreciation is going to be difficult or unlikely. In fact, we believe stock price depreciation is much more likely to become the standard rather than stock price appreciation. This has happened very few times in history. There are very few times in history, and I have a chart for you, I believe, that shows that very few times in history have we had back-to-back terrible years in the stock market. So there's a chance we could be wrong. There's a chance that some of this is already priced into the market. We don't believe so, though, and I'll show you why at the end. So what strategies would we prefer to use as opposed to the standard strategy of buying companies that they think will be more valuable in the next year or two? And that strategy would be to move up in quality, and the reason behind that is we want to make sure that we can serve as much of our base values as we can, because each time we start, each year we start, or each session of the marketplace, you start from your current valuation, and we want to keep that valuation as high as possible. Excuse me. We also want to concentrate our investment process not on depending on appreciation of securities. We want to make sure that we concentrate on income and dividends, because right now, income and dividends are much more consistent. They're much more secure. They're likely to continue increasing over time. And companies that are paying high dividends and or generating real income tend to be higher quality, and they tend to go down much less than those companies that don't pay dividends and or aren't what we call high quality companies. Okay, next. What's the most intelligent activity to engage in during a market downturn? And we think it's to create a wish list. So it's sort of the same thing that we all did when we were younger, and we had limited finances, and we had to write down things that we wanted to spend that money on so we could save for those things. Most all of us went through that same type of sort of growing up pains. But when it comes to having a wish list of companies that you want to buy, how do you do it? And this is a simple couple-step process that each of you can do or engage in, and it's easy. It's really easy to do. First, think about what the most attractive industries are, in your opinion, over the next 10 years. And again, we can help you with all of these things. We can help flesh out your specific goals and your predilections for the next 10 years. So you might want to think about what will grow for sure, for certain. You might want to think about what trends are most certain, or which trends are based on demographics. You certainly might want to have the industries that are most consistently demanded, like food or energy products. Once you have those industries thought or picked out, then talk about, or then think about choosing the most dominant or the best companies within those industries. Don't forget, you're going to be doing this without worrying about the price of those companies right now. You're just picking the most attractive industries and the best companies within those industries. And then you're going to whittle down the ideal prices, and make sure that these companies are paying current dividends. I can help you with that also. What this allows you to really do is to stop focusing on the downturn and turn the downturn into your advantage, because now you have an outline of what you want to buy, the prices that you want to pay for it, and you'll end up at some point during the downturn of buying these companies at bargain prices. As Warren Buffett says, you will have been greedy when others are fearful. Third, and just to move on and be sort of respectful for each person's Friday afternoon, what keeps me up at night? And I do want to tell you that one of the families that we serve asked me this question the other day, and I couldn't answer it, but it made me stop and think really hard about what's going on. And I will tell you that it isn't that we're getting ready to go into a recession. I don't really worry about that very much. And the reason is we go through these things all the time. They're unpleasant. I get it. It's sort of like exercising every day. You know, we know we're going to do it. It isn't that much fun. In fact, I still loathe it. But you know, it's got to be done. It isn't a global recession. Doesn't worry me. We have them once every decade or so. They're painful. Things change, but it doesn't really worry me that much, because humankind is creative. We're really intelligent, and we find ways around. And from those recessions or those retractions of economic valuations, we come out on the other side pretty doggone well. And it isn't bear markets. You know, bear markets affect everyone's investment portfolio. Again, they're unpleasant. But as you can see from the chart that's attached to this slide, bear markets, just like tremendous and damaging thunderstorms or tornadoes, they create, I guess, what I would say that is the base for future growth. And in each of these, I guess you'd call them bear markets or downturns in the marketplace, you'll see that there's a tremendous upturn that follows that. That's multiples of the downturn. What really keeps me up is the geopolitical activity that we've engaged in. It is at any juncture, it could challenge our world. We have so many companies, or excuse me, so many countries that are enabled with nuclear armaments. And again, this is not something that any of you haven't thought about before, but these are the things that keep me up at night. It's the Ukrainian war. It's China attempting to regain its dominance over Taiwan. And what would the United States do in that instance? You know, what would happen? What would we do? Those are frightening. It's the European Union breaking up. These are frightening sort of events to me, and they're much more important than any of the current events that are taking place currently. What's the market missing? And again, we do this each month because these parts, the market prices in just about everything that you can think of, plus a lot of things that you haven't thought of. What the market's missing is something that we think can really move markets. And we want to make sure that each of you are aware of these things, because the market isn't pricing in what I'm going to go over with you right now. So right now, the market believes that inflation is going to be a lot more transient than history shows it's going to be. So history shows that inflation is way more persistent. We went over this last time, but I think it's worthwhile because the market still isn't embracing this. Here's what the market believes is happening as far as inflation goes. As you can see, this is the five-year forward inflation expectations. And as you can see, in 2022, we thought inflation would be somewhere in that 2.5, maybe, well, not quite 3% level. We were incredibly wrong. The chart we had last time, I want to bring it back up because it shows that once inflation gets above 8%, it takes a median of 6 or more years to get back to below 3%, not the 2% Fed's target, but below 3%. That is, if that is the case, and you would tell me we have another 5 years plus of 4 or 5% interest rates ahead, I would be incredibly depressed. You know, that will wreck our marketplace. I can promise you that. So if there's something in the mix that history shows allows us to recover from this inflationary bout much sooner than every single instance in history, that's great. If not, if history prevails, we're in real trouble financially. Here's what the Fed is trying to avoid by raising interest rates. This is what happened during the 70s and the 80s. And as you can see, the money supply growth is it's in red, and the inflation is in black. And as you can see, the money supply growth tends to lead inflation one way or the other. What you'll see is during the 70s, inflation peaked its first time at around 9%. And as you can imagine, we tried to kill it by taking the money, all the money we could, out of the marketplace, and it did kill it for a while. Excuse me, the inflation is the other piece. Let me see. Yep, inflation is the red line. So sorry, couldn't see. What we're trying to avoid is having inflation come down and then peak again at levels that were even higher than the last bout of inflation. And that's what's haunting the Fed. Chair Powell has said this so many times that he refers back to Paul Volcker's bout with inflation. It's really important that everybody understands that under Arthur Burns' Fed chair time as Fed chair, he thought inflation was licked. He increased money supply. to pull the country out of a recession, a severe recession, and inflation became unanchored again. It was only until, and most of you've known this already, that Paul Volcker came in and really put us into a very severe recession. The reason I'm worried about this is that Chair Powell is convinced that he doesn't want that to happen again. The difference between then and now is that at that time, we had right around $500 billion in debt. Today, we have $27 trillion in debt. It is a number that exceeds our gross domestic product versus in those days, it was a small fraction of our gross domestic product. The bottom line of that is when you start increasing interest rates with $27 trillion in debt, you really change the operating dynamic of our country. It's the same thing with if you were running a company and somebody added 9 times the amount of debt that you used to have on your company. It takes away your ability to maneuver and to initiate growth strategies for the future or any way to get back to even. It's really difficult. And if this happens again with the current debt load, we are again in trouble. And everybody here
I wasn't expecting your tone too.
if you're not muted, you might want to.
I have a Zoom at 1 I'm listening to. You want to sit down and listen? Don't worry about me. No, you might.
If you wanted to mute your phone or mute your computer, we can hear you. Thanks. Okay, so the bottom line of all that is that the Fed is likely to overshoot and to overly restrict our economy, send us into a recession, and at that point, I am fearful that the corporate debt we have on our balance sheets is going to become a problem. Don't forget, about 20% of the Russell 3000 index, that's 3,000 public companies, are zombie companies, and they will not be able to last. They won't be able to operate at 4 or 5 or 6% interest rate levels. And don't forget, those companies are probably, their cost to borrow is probably in the 10 to 15% range. The next point that I believe the market is missing is the same point we brought up last time. And I don't want to sound like a broken record, but the market is still expecting 2023's earnings to grow at 5.5% after expecting 2022's earnings to grow at 7% or more. We think this is ridiculous. And I fault Wall Street for pandering to the companies that they cover, because no company wants the Wall Street analyst to say this company is doing a terrible job and they're going to lose money this year. But it's just the truth. Here's a chart that will demonstrate what I'm talking about. Here you can clearly see that the blue line is the ISM manufacturing, and the red dotted line it's a compilation of the leading economic indicators. The LEIs, the LEIs, or leading economic indicators, are at levels that we haven't seen in history. We didn't have LEIs back before the 70s. Excuse me. It is preposterous to have access to this information and to think that we're going to grow with interest rates that are 400 basis points higher than they used to be. And the relative increase of that is awesome. We've gone from about 25 basis points in debt or in interest rates to 4.5, and we're probably going to end up in the mid 5s before this is all over. And to see what's happening with our manufacturing base and to see what's happening with the leading economic indicators. These leading economic indicators, they're not leading, they're leading for a reason. And it's very clear to us that we're going to have trouble on the horizon. What's the estimated value of our market? We did this last time, and it's unchanged. You know, our outlook is unchanged. We believe that we'll be lucky for 2023 earnings to be $200 a share. We think it's more like in the $180 to $200 range, but let's just say it's $200 a share because it's an easy number to use. The average multiple of earnings over the last 100 years has been about 15 times earnings. 15 times 200 is 3,000. The current S&P 500 is at 3,800, 3,850. That's $850 less than fair value, or about another 20% downside to reach fair value. I want to take a moment and just make sure that expectations are well grounded. When you start a correction, there's almost never been a correction that stops at the average multiple of earnings. It almost always continues because the narrative changes, and we go from people calling me all the time asking me what I should be buying now that, you know, the market's off 20%. Hey, you know, market, things are on sale, maybe I should be buying something. It will come, the bottoms will be in when people call me at the bottom and they say, I want to sell everything. They, you know, human emotions hurt us. And that's what I'm hopeful that these short meetings will help regarding the family office families. So let me stop there and find out if there are any questions from those who are participating here today. I think there might have been one that I saw come across. And Marissa, could you go through and see if anybody either has their hand raised? We can do those first, or if there's been any questions sent in.
I have not received, excuse me, any questions in the chat, and I haven't seen any hands raised either.
Okay. All right. So if there are no questions, then we're good. Again, my simple request to each of you is just so that we can continue to make these meetings a little bit more interactive and more town hall like. Would please send me your comments about ways to make these more interactive and more inclusive. We as I sent out in the original memo, you know, I know each of you very well, and I will tell you there's a tremendous amount of tremendous brain trust within this family office, of very diverse backgrounds, and there's an incredible amount of value in the diversity of thought from intelligent people. And again, I'm not trying to be a complimentary Tom. I'm just trying to say that if we work hard on being interactive and having town hall meetings that allow you to voice your disapproval of things or your approval of things or new ideas, everyone will benefit. With that said, I truly am wishing each of you a wonderful, healthy 2023 and an interesting 2023, because having a year go by without having lots of interesting things happen is boring. So with that said, God bless. And
Stephen, sorry, let me interrupt real quick. We've got a question. Any thoughts on how real estate, commercial, and residential will play into trends this coming year?
I do, yes. I sort of thought about and decided not to add that because it's a specific vertical in our economy. but it is it's going to get crushed. Not crushed to the point that we're going to have another 2007, 2008, but we could. Don't forget, the Canadian market never corrected, and the Canadian market was more levered than the US market. It's just that their banks were more well capitalized. The reason I bring that up is we've gone, we're coming off of years where real estate prices were up 20 or 25%, where the normal appreciation rate for a piece of real estate is about 3% a year. It's about inflation. So if the family that asked the question would like to go through that, I have 6 or 7 charts that are very telling about where we think real estate prices will go. It got way ahead of itself. So the bottom line is real estate prices are much more likely to come down. It's just like the stock market when it gets overvalued. Something will happen that will cause fair valuation to come back into focus. And it's going to happen in the real estate market. So for those of you, I know my son has been looking around for a house for a while, and it's been very, very difficult to sit on your hands. But over the course of the next 2 years, we believe real estate values will become more well anchored based on history. But it probably won't be until interest rates start to come back down. I hope that helps. And if it doesn't help, make sure you just give me a call and we can talk about it more, because there's a lot more information available on that. Marissa, anything else?
That was everything.
Okay. All right. So sorry, this went a little bit over today. I'm sorry. Again, I'll look forward to hearing from each of you if you have time. And again, no diplomacy necessary. Let me know how you think we might be able to improve these meetings. And God bless everyone and stay healthy. Bye now.